In today's video, I'm going to talk about 2 ways to think about your Social Security filing strategy in order to improve the safety of your retirement plan. Let's get into it. Now, the topic of the break even for filing at different Social Security ages is a topic that is discussed ad nauseum, and you've likely seen a number of these analyses. Unfortunately, a lot of these analyses leave out some very important parts of Social Security, such as the tax benefits of Social Security, the fact that Social Security is an inflation-adjusted asset, as well as they leave out the sequence of return risk that your portfolio can have. Now, although these variables are extremely important, the 2 most important variables are going to be longevity and your portfolio return in a break-even analysis. And so if we think about longevity, if you have very poor longevity and you only live to age 75, regardless of any other variables, it's going to make more sense for you to file for Social Security earlier. On the flip side, however, if you have great longevity and you live into your 90s, outside of some incredible portfolio return, no matter how you work the numbers out, it's going to make more sense for you to delay your Social Security benefit because of those increases as well as inflation adjustments. Another extremely important variable is going to be your portfolio return. And so the lower your portfolio return, the more it's going to make sense to delay your Social Security benefit because you're getting increases while delaying. The higher your portfolio return, on the other hand, the more it's going to make sense for you to file earlier. On the right-hand side of the screen, I have a break-even analysis, and we're simulating a portfolio with 10% growth. And as you can see, despite these 2 lines almost converging towards the end of this person's retirement, they never actually touch. And that's because this person would be better off filing earlier and earning that higher return. We see that the break-even never actually happens. Now, this might surprise some of you, but through all of the break-even analysis we've done here at Safeguard, you basically need to earn a double-digit return for that break-even to never happen. But now I'm going to reframe your Social Security filing strategy in 2 different ways and show why delaying can actually have some unexpected benefits. First, let's look at using Social Security as a safe alternative. And so when we open up someone's portfolio, that portfolio likely has a portion invested in stocks for added growth, but those stocks have some volatility. And so in order to add safety to a portfolio, what I see are retirees holding things like bonds and cash. And this makes a lot of sense. We want a balanced portfolio, both with growth as well as with risk. But when we think about the idea of filing early and investing and allowing more to stay within your portfolio and thus earn a return that can outpace delaying your Social Security benefit, all of the benefit of that file and invest strategy comes from the stock allocation. Remember, we need to earn a high enough growth rate for that portfolio return to outpace the extra benefits we gain from delaying our Social Security benefit. And so it's really just the stock allocation that's delivering all of those benefits. We're never going to see bonds and cash outperform at a high enough return for that to make more sense than delaying Social Security. And so what if we looked at using Social Security as a safe asset? And in order to delay our Social Security benefit, we first used bonds and cash, essentially replacing them as a safe alternative within our portfolio. Now, on the right-hand side of the screen, I have a chart that shows what you can expect from bonds over the next 10 years on an annualized basis. Now, in blue, you'll basically see the 10-year starting Treasury yield, and then in orange, you'll see the annualized 10-year return of an intermediate bond portfolio. And not surprisingly, these 2 numbers are highly correlated. Said differently, the starting yield is essentially what you can expect to earn as an annual return over the next 10 years in bonds. And you can see that there is some variation here. In a rising interest rate environment, you're likely going to earn less than the starting yield. In a falling interest rate environment, you might earn a little bit more. And so there is some variation here, but we see they're highly correlated. Well, right now, as recording this video, the 10-year Treasury bond is right at about 3.7%. Well, what if we looked at then using the bond portfolio in order to supplement our income in the first part of retirement in order to delay Social Security? And so we use up those bonds first. And here are the options we have. We can either take Social Security early and maintain that bond portfolio and essentially have expected returns right around that 4% range, or we can use the safety first in order to delay our Social Security benefit. By delaying, we're going to earn a 6 to 8% increase in our Social Security income plus inflation estimates. And so on a regular basis, we can expect to earn almost a double-digit increase on our Social Security benefit when we look at all of the benefits of delaying. And on the left-hand side of the screen, I have a hypothetical illustration showing a bond portfolio compared to delaying your Social Security benefit. And as you can see, not only is the break-even analysis right away once you pass age 80, but not only that, the gap between filing at age 62 versus filing at age 70 quickly grows to over $500,000 and even $1 million later in retirement. And really, this isn't that surprising. These are both safe assets. The Social Security benefit, in my opinion, is much safer, but also it offers much higher upside as well. And so, not surprisingly, we see that using up that safe asset first to delay your Social Security benefit makes a lot of sense. But let's take this one step further. For instance, when we start building out allocations, most people look at break-even analysis with assuming that you keep the same portfolio in both scenarios. So for instance, if we look at a classic 60-40 portfolio, you would keep that 60-40 portfolio whether you filed at age 62 or whether you filed at age 70. And if we think about how you should really set up your retirement portfolio, this doesn't make a whole lot of sense. Usually we want to match the income need that we have to the safety within that portfolio. If we don't need any income, we can go a lot more aggressive than if we need a lot of income. And so what you see on the screen first are the two income scenarios we would have based on filing at 62 versus filing at 70. Notice that if you file at age 62, you're going to have an increasing gap that you need to fill with your portfolio. Versus filing at age 70, you have a starting gap that's quite large, but then that gap falls. And so if we just think about your portfolio and optimizing it for your income needs, we would need to maintain a lot more safety for the long run if you file at age 62 versus if you filed at age 70. We need to start out with more safety filing at age 70, and then we'd be able to flip to a little bit more growth. And if we look at the results running simulations under this environment, let's look at a couple, age 62. They have $1.15 million in savings, $4,200 in combined Social Security benefits at full retirement age, and they need $90,000 worth of income on a rolling basis. And so if we look at filing at age 62 and we look at a 25-year retirement, out of all 1,000 simulations we ran, filing at age 62 with a 60-40 portfolio had an 88% probability of success and left you with about a $1.3 million median ending portfolio, and that's in inflation-adjusted terms. At a 30-year retirement, you see that probability of success drop down to 80%, and the median ending portfolio is right around $1.15 million. So basically right around where you started. And if we compare this to filing at age 70, what we'll see in both scenarios is that the probability of success rises substantially, meaning you have a safer retirement. In the 25-year retirement, we see that this rises by about 6 percentage points, and the median portfolio also rises by about $60,000 in inflation-adjusted terms. In a 30-year retirement, we see the probability of success rises by 11 percentage points, and we see the median ending portfolio rises by about $200,000 almost. Another way to think about Social Security is thinking about Social Security as insurance. That's essentially what it was designed to be, longevity insurance. And so what is your ultimate goal with your Social Security filing strategy? Is it to maximize retirement safety, or is it to try to earn a benefit on filing early for your Social Security benefit in order to aim to have the largest estate? These are two different goals, and having either goal is completely fine, but you need to be clear about which goal you actually have. And so when we think about where the risks in retirement come, we see that there is very little risk of failure in the first 8 to 10 years of retirement while you'd be delaying your Social Security benefit. You'd either have to see some incredibly poor market returns or make some incredibly poor decisions within your retirement plan to fail in the first 10 years of retirement. On the flip side, however, after 10 years of retirement, the risk of failure starts to grow throughout the rest of your retirement. The farther out you get, the bigger risk of failure you have. Let's analyze the question, what happens if you do run out of money? Now, this is obviously something that no retiree wants to face, but is one that we should be planning for as downside protection. And so on the left-hand side of the screen, I have a simulated portfolio looking at filing as early as 62 versus delaying until 70. And you can see in the simulated environment that both portfolios end up running out before this retiree reaches 100 if they so live that long. But the question that I want to ask is what's left when you run out of money? And we see that the age 62 portfolio runs out of money right around age 87. And so let's say that both portfolios ran out of money at this point. Again, this obviously wouldn't be an ideal outcome, but on the downside, what do we have left? What do we have to live off of? And if we filed for our benefit at age 62, we'd find that we have about $67,000 per year coming in from Social Security. However, if we filed at age 70 and we ran out of money at, let's say, age 87, I realize the graph shows running out of money in your 90s, but let's say we ran out of money at age 87, we would have $119,000 almost per year to live off of. And so we have a huge increase in the income that we now have for the rest of our retirement. And so as an additional point, this is also where a lot of break-even analysis start to fall apart. First, keep in mind that Social Security is a form of insurance policy. And so comparing a volatile portfolio to an insurance type asset really leads to a more difficult comparison. On the flip side as well, when we do see portfolios run out of money, keep in mind that these are not equal scenarios. Your portfolio filing at 62 runs out of money versus your portfolio filing at age 70 runs out of money. Those are not equal comparisons as we're showing on the screen right now. Now, keep in mind, this video is not meant to push everybody to delaying their Social Security benefit. Ultimately, your Social Security filing strategy has to be customized to your situation. And based on the particulars of your situation, you're likely going to see a different optimal strategy than, let's say, your neighbor or your coworker. And so it's very important to have a personalized Social Security filing strategy. Here at Safeguard, we have some clients where it makes sense to file as early as 62, while we have other clients that delay all the way to 70. I'd say the majority of filing strategies that we use with our clients is something in the way of a split strategy. Now, because Social Security is such a complex asset to plan for, I see a lot of retirees believing myths around Social Security that simply aren't true. And I debunk 5 of those myths in this video right here. You can click on this video to learn more. Always remember, you don't need more money, you need a better plan. Thanks for watching, and we'll see you in the next video.